without getting into specifics, I mean, I think that's another reason why I like the job. Sometimes you are kind of doing some problem solving and thinking of unique ideas to find solutions to ensure that you're successful in raising the capital required.
In this episode of Investors and Operators, I am talking with Pete Purcell at Triago. So we're going to talk a lot about fundraising today, the do's and the don'ts during fundraising, who should raise a fund, who should not raise a fund. We're not really going to talk about industry trends in fundraising because y'all know how that is right now. We're going to talk about how to be more effective in the fundraise. But to kick off, I will turn it over to Pete for just an overview about Triago, background on the company, and what you guys do.
Sure, yeah. We're a global placement agent or private capital advisory firm. We've been around a little over 30 years. We're headquartered out of Paris, France. Largest office is in New York, and I am based on the West Coast in our San Diego office. So the firm really has three primary lines of business. One is raising, blind pool funds. So private capital funds. A lot of that is private equity, a lot of lower middle market private equity, middle market private equity as well. We also, raise VC funds as well as, private credit funds. So that's one line of our business. I would say the majority of the funds, a lot of emerging manager funds. So a lot of fund ones, a lot of fund twos. So that's one piece, one leg of our business. We also work with a lot of emerging managers and independent sponsors to raise capital on a deal by deal basis. And that's been a great business for us. And we have a lot of folks with deal backgrounds, which helps us out a lot in that regard. And in that kind of zone, most of those deals are lower middle market or middle market buyout deals, nearly all of them. But of course, we also raise capital for other types of situations or asset classes within that vein. And then the third leg of the stool is our secondary advisory business. So both GP-leds and also working with LPs to help them manage their portfolio, which has been an active piece of our business over the last 18 months, as you can imagine. And then we have a strategic advisory group as well that advises GPs on different types of strategic situations. So that's really our business in a nutshell. We're about 60 people globally, and most of that is in Europe as well as the US. We also have an office in Dubai. So that's us in a nutshell.
Cool. So let's dive into it. Who should raise a fund one right now, and who should not raise a fund?
I think in terms of who should raise a fund one, I think, it's groups that have a strong team, a strong presence within their sector, groups that have demonstrated a track record, have at least one, maybe two realizations. The team has worked together, ideally outside, if they have a former fund they're a part of. Ideally, they've worked together for 4 or 5 deals at a minimum and had great success. This is a very difficult market, to take someone else's slot away. So you certainly need to have the pedigree. You need to have some existing institutional relationships coming in. You need to have folks that like you, like what you're doing, think highly of you, and are going to back you going forward. Ideally, some of those folks came into your deals as an independent sponsor, and they want to work. They like what you're doing, and they want to keep going with you. That's kind of one aspect of it. Another situation could be a group spun out of a larger fund or a larger platform, and they kind of took a team and spun out. And those situations also can work as long as that team has worked together in the past. And maybe they start out with a deal or two as well outside of the fund before they jump into it. And and obviously they would need to have groups that were in the prior platform's funds, and those that know their performance, that know their contribution, if you will, and that want to back them going forward. I think that's critical, is to have folks that, hey, we already know these guys, we like what they're doing. These guys or girls, we like what they're doing. We want to work with them going forward. I think those are kind of the groups, who should be thinking about or raising fund or ready to. Yeah. And again, the track record is critical on that front.
So what are the things that people might be overestimating about what they're offering in a fundraise, or just might not know about, and you just keep on seeing it, and you just wish that more managers would know this before they start thinking about a fundraise or they're about to kick it off?
Sure. I mean, I think, a lot of folks out there, would love to raise a fund, right? We hear it all the time. There's a lot of background work at the beginning. There's a lot of preparation that needs to have taken place. Material prep. VDR has to be ready to go day one. I think you need to have conversations with folks as well as other relationships well before you launch. You need to get a good sense of, what the institutional market thinks of you prior to going out and launching. Whisper campaigns. Talk to 30 or 40 groups before you go out. Have all your materials, have everything buttoned up and ready to go. Those are the things you really need to be ready for, because it's very competitive, especially with the kind of the limited LP dollars right now. Yeah. It's extremely competitive. They have a lot of options.
Do you think that people do not do the whisper campaign to the extent that they need to, and then that they're as honest with themselves on the feedback?
I think there's certainly cases where that happens, and I guess we're talking about fund ones right now. Maybe I'd have some different thoughts if you're a fund 3 or something like that. But yeah, I think number one, it's really getting a good sense, because plenty of folks can tell you they like what you're doing, but what does that mean? And I think you need to have pretty real conversations, at least to be in a place where you feel pretty good about a handful of groups that are brand name groups that other folks respect and think highly of when you're going out to raise a fund.
So once a firm decides to do the fundraise, and maybe they're working with you, what does that process actually look like? Just to kind of set expectations about timeline, what do they need to have early on that they just might not have expected, how much time and effort it's really going to take up front to get it going?
Yeah, I mean, I think it depends on where they are in their life cycle, and what is the team makeup? What is the size of the team? Do we have 10? Do we have a 10 or 12 folks on the team? Do we have 3 or 4? So it's a different they have different resources to begin and get ready. I think, in terms of what do they need to have, like the timeline of the fundraise, you're going to need a few months to prepare. You're going to need that time to talk to your existing investors. And ideally, you've been talking to them about this for the last year plus, right? And so they have a good sense of when you think you're ready to go and launch that fund one. And then as you're doing that, as you're talking to investors, you're building up kind of momentum. You're building up a group of investors that to give you the best shot at landing those 5 or 10 that are going to come into that first close. So that's critical. In addition, alongside of that, you need to make sure that you've got all your docs ready. You need to have your data room ready. The last thing you want to do is go into a meeting. They really like what you said. They really like the story. They like the deck, etc. They're like, what are the next steps? I'd like to dig in. And the VDR will be open in a few weeks or something. You want to, it's always timely. You need to be kind of ready day one with that stuff. I think, other things that you need to have kind of down when you go in. And some groups already have this kind of early on because they've been raising capital on a deal by deal basis from institutional folks. So they already have their pitch down, their deck is in good shape, et cetera. That's great. Other groups, maybe they need some work on the pitch, which, we do with most or pretty much all of our clients in terms of just kind of doing some practice sessions, maybe a little more of this, a little less of that. Let's make sure we're hitting the key points. Let's make sure the flow is good. We may want to work with certain groups, again, depending on what the materials look like when we come in. We might be more hands-on in the materials, or we might really not need to do much at all in the materials, depending on their levels of sophistication and kind of what those decks look like.
Well, let's double click on the pitch. So yeah. What are some of the common characteristics from the best pitches you have seen with emerging managers? And what are some of the common mistakes that are done in these first pitches?
I think in terms of the best pitches, there's a good story as to why, why the team got together, why you're doing what you're doing, why you think this is a special or unique opportunity, what makes you different, et cetera. In terms of kind of the flow of the pitch, the good pitch is, it's kind of getting to know you a little bit. Here's, find out who they are at the beginning, right? Who are you talking to? What are they interested in learning? How can you be most helpful today to help them get to know it, to kind of help them get to know what you're doing, get to know the fund. What is the fund going to look like? Who are you guys? Who are you girls? Etc. I think that's critical. So first part, you kind of give the background, give the overview. What is the sector that you're playing in? Explain that. Why are you playing in it? Why do you like it? And then what's the secret sauce? What's the secret sauce of what you guys are doing? Certainly, how have you sourced your deals in the past? That's a critical spot folks want to know about. But I think what the good presentations do is they get, pretty quickly into their portfolio, because that's really what, the LPs want to hear about, because that's how they're going to evaluate. That's how they're going to do a majority of their evaluation on it is, okay, well, let's look at your portfolio. How did you source that? What's the performance been like since you've acquired, this business? What are some of the things you've done? And so you can spend a good portion of the time on the portfolio, and that gives the investor really the best sense of what they're getting into in terms of, this is what I would be investing in if I invested into the fund. And then, you need to spend the last, and I'm assuming an hour here, right? But you need to spend the last 15 to 20 minutes talking about, really two things. One being, ideally you've got a deal to talk about, right? You want to have a deal ready to go or close to ready to go once you start having conversations. And that'll give folks a flavor of, hey, this is kind of what you'd be investing in. This deal ideally is going to go into the fund, or maybe part of it's going to go into the fund. In addition to that, you want to talk about your pipeline, because, it's likely that a couple of those deals in the pipeline are going to be going into the fund. So what does that look and feel like? And, diving back into the sourcing, I think folks really want to understand exactly how you're sourcing. Are you just participating in bake-offs? I'm sorry, are you just participating in auctions? Or are you, are there different ways you're finding these? Are you using a network? And then, are folks that you've already invested with or founders of your existing portfolio companies, let's say, are they making introductions to other folks in their network, other owners that might be looking to sell? That's a great way to get it in. Yeah, I think those are some of the keys right there.
And on the most common mistakes during pitches, the ones that you cringe, you're in the meeting like, oh my God, please don't say this. What are some of those common mistakes in pitches that they can just fix through reps in the gym?
Common mistakes. I mean, that's a good question, Jordan. We typically have been working with groups that don't make those mistakes because they've had round trips while they've been doing deal by deal, or they've done this before. But I suppose one mistake. Here's one: giving a 20-minute or 25-minute introduction on yourself and your background, like one or two people. That's you basically already taken up half the meeting. I don't think you want to, you don't want to, you've got an hour to work with, that's certain. We've seen that where, wow, I'm 35 minutes in and all I've heard about is kind of a background and why you're going out and doing this. We're almost out of time here. So that's definitely a mistake that we've seen quite a bit,
So it sounds like time management during that first meeting with an LP and spending too much time on the founders' backgrounds.
Yeah, that's right. I mean, that's part of it. I think, sometimes folks will spend, a question that was supposed to be, that likely would be answered in 2 minutes, and they're answering it in 8. That's another mistake that gets made a lot, where, it's just long-winded and it's not necessary. Especially if it's more of a theoretical question about the strategy or the space, that will happen a lot. And I don't think the person asking the question was looking for a 10-minute, dialogue about this particular sector and, some of the regulatory issues within the sector, whatever it may be. So I think, tighter answers are better. but you do want it to be a flow. So you don't want to, you want it to be a back and forth. You definitely don't want to be, I guess another mistake folks will make is they will page flip. Going page by page, you're going to put someone to sleep pretty quickly. Once they start kind of pressing their golf finger in the middle of it, or kind of looking off to the side, and you've lost them. So you don't want that. Yeah, page flipping is also not a good way to start that relationship. So you want to make it. There's probably a few pages that you want to point to throughout the conversation, but it's certainly not all of them.
So how do you know when someone's interested? What are some of the signals that you see that means, all right, this is interesting for them and we need to follow up?
I think a lot of times you can kind of see it's based on some of the questions that they're asking and some of the comments they're making and how engaged they are. If you sit there and they've only asked 3 questions in 45 minutes or an hour, that probably not all that engaged, right? If it's a good back and forth, there's a good vibe. A lot of this is just, you can tell gut wise how it's going, to be honest. I wish I had a better answer for you, but I think it's that. It's level of engagement. Are there some similarities they're bringing up to other funds or other folks they like, or do they have some familiarity with your space and your deals? Or is this totally foreign to them? Are they saying to you, yeah, we really haven't done much in this space. If they haven't done much in the space, that's typically not a good sign unless they're looking for something different and they like what you're doing. So, yeah.
So let's talk about anchor investors and just how should GPs be thinking about quality anchor investors and even getting down to terms that are the non-negotiables and terms that they need to be like, hey, in this market, let it go, get it raised.
So I think in terms of how you're thinking about anchors, it doesn't have to be, but it very much usually is someone that knows you well already. Maybe they've invested in one of your deals. That's a relationship that you've been working on and had likely for over a year. And you have to get them started early, especially if they're a large anchor. It's likely that their process takes longer. And so you want to think about brand names or groups that are well respected by other like-minded investors or other institutional LPs. So if it's a brand name investor, it's a group that others can say, oh, okay, that makes me feel warm and cozy inside. Those guys are legit. I keep saying guys. You're going to have to. Those guys or girls that group is legit. It's critical to have a couple brand name investors or one if it's a large kind of anchor into the first close, or at least doing work while you have a first close. If you've already got a good amount of capital lined up for that, you need to have sort of those names that have either backed you in the past that others trust and respect coming into the close or having coming into your deals in the past. I think that's a critical piece because it really kind of lets the rest of the market know, hey, this is real. This group is going to raise a fund, and they're getting backed by some folks that are pretty smart.
So as they're going throughout the fundraising process, what's the most effective way? What are some of the most effective ways to manage momentum during a fundraise? So it doesn't just have a great first meeting that fizzles out, or a great first meeting and their message just gets lost at that LP's investment committee. Like, how do you manage the momentum during a fundraise?
Well, I think it's a couple of things. One, it's deals. So it's, hey, we've got this co-investment available right now, and updating them on the performance of your portfolio as well as your deals. And then when you say momentum, to me, momentum means, okay, we're charging toward a first close, continuing to update the groups behind them, the groups that might be able to come into a second close, and letting them know what's going on with the firm, what's going on with XYZ portfolio company. We just made an acquisition on company, C from our portfolio. I think it's those positive updates. We just sold the company, and here's the mark. Here's what we got on that. Those are some of the things and the tools that you would want to utilize. And then as you get close to the first close, and then as you have the first close, you want to let everyone know. We had the first close. We've got a ton of momentum, a ton of demand in the market for our fund. And we would love to, to talk to you about your next steps. By the way, oh, you're busy? How about we talk about our pipeline? Here's what our second and third deal that are going to come into the fund look like. How about we hop on the phone and spend 45 minutes talking about the pipeline? Those are some of the tools. I think there are others. There certainly are others, but those are some of those tools. Maybe just stepping back, because I think I forgot to answer one part of your question when you talked about anchors and fee breaks. I think certainly first closers are going to, especially in this market, are going to expect a fee break. And larger anchor investors are going to expect a fee break, potentially of a larger size. Without getting into actual numbers, that is 100%, standard in today's market. And then based on, demand for the fundraise, a lot of times you're going to need to continue to give fee breaks as you go along based on the size of the investor, because they're used to it and they have other options that will give those fee breaks.
For the funds that have gone into subsequent funds after one, how much is there of this kind of like this buyer's remorse of like, oh God, I shouldn't have done that, versus, you know what, 100%, I had to give my left arm and my right leg for fund one, but where I'm at in fund two and fund three, 100% worth it. It's a question of like, is it worth it?
From the LP's perspective or the GP's perspective?
GP's.
Oh, well, I think it's, look, fund ones are very difficult to raise, but I think it's completely worth it because, none of these groups are going to underwrite you for one fund. They're going to underwrite you for at least two, maybe three, but at least two funds typically. So I think it's completely worth it to put in the blood, sweat, and tears, or whatever you want to call it, on fund one, in order to get you to. I mean, that's your business. You're setting up your business, and so it's worth all that energy and effort. But you got to make sure you knock it out of the park on fund one, because in many regards, that's your most important performance fund as you move on to fund two is probably pretty much there, right? And then as you move to fund three, though, they're going to be looking back at fund one and in a certain and fund two, to some extent as well. But certainly the performance of fund one and how that's turned out, 5 years later or something.
Why do you do this?
Does that make sense?
Yeah. Shifting gears, why do you do this?
I enjoy it. I come to work every day, excited to get up bright and early on the West Coast. I enjoy working with smart, motivated folks and, doing some unique, interesting things. And, I've spent time both in the sell side as well, sell side M&A on deals as well as in the buy side. And then this just seemed to fit me in terms of my personality and kind of how I like to work. And I've been taught by some great, folks, some great mentors along the way. And I have fun. So I think that's why. And again, it goes back to who you're working with. I typically don't work with, we don't work with folks that we don't enjoy working with. Life's too short. There's plenty of, private equity fund managers out there. That's pretty much why, Jordan.
What are some difficult times in a fundraise that, you and maybe the manager didn't know, like, I don't know if we're going to get through this, but how did the team, including you guys, get through that?
Well, that'll happen. That happens quite a bit in fundraisers. I think you have to understand that, sometimes it can be a grind, especially in a difficult market. And, maybe certain things have happened within the portfolio that have slowed it down. Perhaps there was a realization that was expected. It didn't happen, but you still need to raise capital because you're out of capital here. I think you need to be creative in terms of finding solutions and finding ways to incentivize LPs to do work and to come in. And there's a number of tools that you can use, but I think it, and that's that's kind of part of our job is to help work through that with our clients in terms of, okay, we're at a point where we're going through a little bit of a struggle. What can we do to get this train rolling again? And that's where it's kind of all hands on deck. And that's a benefit of having, for myself, it's a benefit of also not only having great clients, but having great team members to help out with, here's an idea. Why don't we go to this group and talk about XYZ without getting into specifics? I mean, I think that's another reason why I like the job. Sometimes you are kind of doing some problem solving and thinking of unique ideas to find solutions to ensure that you're successful in raising the capital required.
And outside of fundraising, outside of what you're doing, what do you like to do either for personal time, family time, charity time?
Yeah. I've got two daughters, so spend a lot of time with the girls, my wife. They like to play a lot of golf, so that's what we do. They're 5 and 9, so we spend a lot of time. I spend a lot of time out there now, not so much playing, but more so helping them and just spending time with them. Other than that, just living in San Diego, which is pretty good.
And I'm going to continue down this route of parenting. What have you thought about, like, what are our jobs as parents? Like, how do we know when they're 18? Like, I got a 4-year-old and a 7-year-old. How do we know if we've done a good job?
I have no idea, Jordan. I thought this was a podcast about raising capital. I guess maybe if you've done a good job if they still want to spend time with you.
I think
Fingers
that's
crossed.
a fantastic way to think about it. So maybe at 11 or 12 years old, when they start to have that shift, I don't know when that is, maybe 9 or 10, if they still want to spend time with us. That is a fantastic way to know if we've done a good job. And that is a great place to end.
I love that. When maybe for you, it's if you're doing a triathlon with them or something, right?
I think, as long as I think one of the many ways that we're approaching it is if our kids enjoy fitness, and it's a cornerstone, if our kids know what giving means to other people with volunteering. We have a lot of work that we do with our nonprofits. And if they're, at the end of the day, if they're happy and they truly enjoy the work that they're doing, like I was thinking about this morning when I was listening to My First Million podcast, someone was asked, like, if you had $100 million, what would you do? And one of the persons said some of the most successful people that they interact with, they would do the exact same thing that they're doing. Great. Got money, go on money, whatever. I'm still doing the exact same job. I love what I do. And I think if they can go into something and just being like genuinely curious about the world, then I think that's one of the ways that we're defining success. Like, I don't care if our kids become triathletes and go to college and scholarships or runners or entrepreneurs. Like, if they are just having fun and they're finding meaning, they're making their community. I don't care about the world. I care about, like, the community. If they make their communities better and they have a specific community, fantastic. But I like
touche. Great answer.
I think we both had good dad answers. I like yours better, which is, you know what? If they want to spend time with you when they're 18, that is, or when they're off to college or whenever, like, that's success. And I think that's a good place for us to conclude this fundraising and parenting podcast.
Well, thanks, Jordan. It's been a pleasure, my man.
Appreciate the time. All right. See ya.